Welcome to Channel 17, the Town of Colonie Government Channel.
Welcome to The Money Factor. I'm Richard Naylor, your host. Today, our topic is long-term care insurance and the New York State Partnership for Long-Term Insurance. Our guests are Dr. William Lane. He's with Golden Lane Associates. They're a gerontological consulting firm. Had a little trouble with that. And Monica Kergel. She's field coordinator for long-term care in both Albany and Schenectady counties. Let's meet them and talk about this. What they said was a somewhat simple topic, but I think until we work our way through it, we're not so sure. Welcome.
Hi.
Well, thank you.
Monica and Bill.
Thanks for having us.
Could you give us ladies first, I guess, could you give us a little background on your background?
Sure. I'm Monica Kergel, and I have my MSW. I have my Master's in Social Work, and I have done a lot of work in gerontological studies, and I currently work with Golden Lane Associates. But before that, I did a couple different things, working with some volunteer programs, and also was a director of an adult daycare center. So, enjoying.
So you've got both sides of the experience, some of the education,
Exactly.
some of the hands-on.
Hands-on, yes.
And Bill?
I have a PhD in sociology and spent 25 years directing the gerontology program at the State University of New York at Cortland, and retired in January of 2006. Didn't really retire, I changed jobs to work in my consulting firm here in Del Mar. So I actually still live in central New York and commute over here. And the firm represents a variety of counties, and so we always present ourselves as we should, as representing that county and not our firm.
And indeed, that's how I met you, going through the website of the Albany County area.
Yes.
And you were listed there under long-term care. One maybe stupid question before we go into long-term care. You both use the word gerontology. Is it just the study of aging, or what exactly is that?
Study of aging is the basically geron is refers to old age, and so ology is the study. So it is literally the study of aging. We're really more social gerontologists. I mean, we're both interested in the social side of aging. We don't really deal much with the biology of aging, although we do get into healthcare issues, and we're not really psychologists, so we're more interested in social policy issues and in issues of retirement and research and planning and helping people negotiate the systems and working with programs.
Well, let's start with long-term care. Go into that just a little bit. We're interested in this partnership program, but I think we want to make sure that we understand what long-term care is. You want to both take a stab at that?
Long-term care really deals with services, a very broad range of services, anywhere from medical to personal services for individuals that cannot do things independently for themselves. In connection with long-term care insurance, you're really looking at what's called ADLs, or your activities of daily living. So when an individual has difficulty doing their ADLs, things like eating, dressing, toileting, even all the way up to some cognitive impairment. Those are the things where...
Self-medicating, is that, if someone can't take their medicine, does that count?
Mm-hmm. Yeah. So those are the kinds of things. Anything that really individuals need to stay independent, stay in their homes. In essence, they'll need assistance with those things.
And these are really problems from which we will never probably fully recover. We'll have functional limitations. You know, we all have acute illnesses, and we may even occasionally go to the hospital and have an operation, or we're out with the flu for a few days, but we take some medications and we recover and we're back to normal. But with long-term care, you're dealing with issues that have impaired function that you may have some recovery, but you're never going to recover back fully, and you're always going to need some level of assistance.
So now we throw in the insurance part. And obviously we're trying to help ourselves do something that we can't do by ourselves. But exactly what is long-term care insurance?
Long-term care insurance will actually pay for those services. So there's a variety of different settings where you can get those services, such as home care. Someone can come into your home and assist you with those services, or in a nursing home, in an assisted living facility, in an adult daycare center. And long-term care insurance will pay for those services.
So,
I don't know if you want to add to that.
a broad range of things that will help you overcome these ADLs.
Yes.
Right.
And there are a whole variety of different kinds of policies. One can buy nursing home insurance only. You can buy something that will pay only for home care, or you can buy insurance that's much more comprehensive and that will pay for everything from home care through assisted living, nursing home care, may even allow you to participate in what's called consumer-directed care, where you can actually hire your own aide and supervise your own care.
And that depends on the particular policy, you're saying?
Depends on the particular policy.
Now, I was thinking in terms of the word dynamics before. What are the main dynamics? And all I meant was, if you were going to write an equation and say, okay, I should think about this, and this is going to interact with this, and this, and this, what would be the main factors that make me buy long-term care insurance or not?
Well, I think from an individual perspective, you're insuring risk. Long-term care insurance is like any insurance. You know, you buy car insurance, you buy homeowners insurance, you buy long-term care insurance, and so you really have to assess your risk and what kinds of family history do you have? Do you have a history of Alzheimer's in your family? Or do you have extreme longevity, where the majority of people in your family live a very long, productive life with very little disability? So there are factors like that. Your age will play into it, and the amount of assets you have. Frankly, if you're a low-income person, you probably won't be able to afford long-term care insurance, but you really don't have assets to protect. On the other hand, if you're a middle to upper-income person, you own a home, you own a business, you have a vacation home, you have a variety of things, you want to be able to protect those assets. And from the state's perspective, the dynamic for the state is really the Medicaid program, because it's an enormous cost factor. It's a huge budgetary item for both the state and the counties, as well as the federal government. And for every person that we can encourage to plan for their long-term care needs and avoid being on the Medicaid program for 2 or 3 or 4 years, that's an enormous savings. So from that perspective, taxpayers have a real interest in making sure that we're all planning for our long-term care needs, whether or not it's through long-term care insurance or doing wills or trusts or saving money or downsizing, or there's a whole range of things one can do.
It would seem that saving money would be the thing that would help pay for this, as opposed to taking it out of the regular tax fund.
Well, if you're looking at, just to throw some statistics out there, for an average stay in a nursing home throughout New York State, you're looking at close to $100,000 a year. That's for 1 year in a nursing home. So when you look at, are you going to be able to save enough money to cover your long-term care costs? That's a pretty serious question. It's very expensive, as most people know. And what we should probably say before we even get into Medicaid, as of now, Medicaid is the main payer of long-term care services when it comes to nursing home level. Close to 80% of all the individuals that are staying in a nursing home, Medicaid is covering the cost of that. And when you think about that and you think of close to $100,000 a year per person, that's a lot of money. So we're really looking at what can we do to chip away at that.
Now we'll come back to that Medicaid and perhaps mention Medicare as well. You said we're protecting against risk.
Mm-hmm.
Now, if the government's going to pay for it, our stay in a nursing home, what is our risk? What are the risks that we might run in different situations by not having long-term care insurance?
Well, first of all, if you cannot afford to pay, or you will have to spend down your assets before the government will pay. I mean, Medicaid is the insurer of last resort. It essentially insures people who have impoverished themselves. I used to tell my students that Medicaid is the best insurance money can't buy. because you have to spend your money, and once you've spent down your income, then you become eligible for Medicaid. And that means losing your assets, and to a large extent it means losing control of your life, because someone else is going to make those decisions for you then.
And does that include your estate? Because many people have to worry about other people in the family, their spouse, for example.
Well, there are obviously rules for spousal impoverishment and those sorts of things. And by the way, when we talk to people, we do not get into the Medicaid program, the ins and outs, because we're not experts in Medicaid. It's a very complicated system. There are people in counties across the state at departments of social services. You can call the New York State Department for Insurance. You can call the partnership. These are people who really know the program, and they can give you the correct information. It's always changing. And so we just defer questions to the experts in that field.
Fair enough, yeah.
But we want people to be aware of, and we'll talk about later, the special kind of Medicaid that the partnership has available to people.
Okay, so a big risk is if you have money, if you have assets, you can lose them through this. What about the quality of the care? You know, many people worry about which nursing home they might be in. With long-term care, is there a chance you would have better surroundings? Or with a lot of money, obviously, you could have any surroundings.
You shouldn't. The only rule I think that really applies is that if you're on Medicaid, you must be in a semi-private room. You must share your room. The state regulations say that there should be no difference in the care.
But you could have then a private room if you had the funds to pay for it.
If you had the funds to pay for it, you can have a private room. That's correct. But almost every nursing home accepts Medicaid. But we all know what the regulations are supposed to be and what the real world is. But I think that by and large, I have enormous respect for the nursing home industry. I think in most nursing homes, I think Monica would agree, if you walk in, you would not have any idea who's a Medicaid recipient and who's a private pay person, unless they have a private room or they're in a semi-private room. That's about the only way you could possibly tell.
Their care cannot change. So if you were private paying to begin with and then went on to Medicaid, there would be absolutely no change in the care that you receive.
So basically, long-term care insurance is about funding, whether it be a nursing home or some in-house help, or a few other situations. Now, you have a special program that the state has developed, and that's one of the things that I learned about when I was trying to find out more about long-term care. Could we talk about that program?
Sure.
The partnership, it's called, I think.
Sure. The partnership offers it's really a partnership between New York State and private insurance. So when you purchase a policy, you are buying the regular private insurance with this new idea of Medicaid extended coverage. And Medicaid extended coverage will basically allow individuals to protect some or all of their assets depending on the type of policy that you purchase, which is something that other policies, your traditional type policies, don't allow you to do. So that's something that's new and very important for individuals to understand. There are policies out there that will allow you coverage that other policies don't provide for you.
Yeah. What happens if you have a partnership policy is that, let's say you buy a policy that will pay for 3 years of care. And let's say the standard rate right now is $198 a day. So that's the minimum daily benefit. You can buy more coverage than that, but let's say you buy a policy that will pay $198 a day. And it will pay $198 a day for 3 years. At the end of that 3 years, you will be eligible for Medicaid. If you have what is called a total asset plan, you will go on Medicaid extended coverage, in which Medicaid will assume that you have no assets. So you don't own a home, you don't have a vacation home, you don't have that nice yacht down on Long Island Sound. I mean, you don't have anything.
Not according to them.
Not according to them.
But you really do.
All they do is look at your income.
No one took those away.
So, using the Medicaid language, there is no asset recovery, there is no spin down, there's no look back period, all of those things that people try to avoid. And that's a total asset plan. There are also dollar for dollar plans, which Monica usually always explains better than I do.
Your dollar for dollar plans are cheaper plans. A total asset plan, it doesn't matter how many assets you have. You can have as much money in the bank as you want. You can have 2 houses. There's no limit to
And
the
he
amount.
said a yacht.
That's
so
right.
Really anything.
I would like to put in my cabin in the Adirondacks. That would be great. So whatever you have for assets they're all protected. In a dollar for dollar plan, the amount of money that was paid out by the insurance company during that, as Bill used a 3-year, say you bought a policy that covered you for 3 years, the amount of money that was paid out for your services, whatever that equals. So in 3 years, if the policy paid out $200,000, you would have $200,000 of asset protection. And you could use that protection for whatever you wanted. So if you had a family home and you wanted to protect that, you could say at the end of those 3 years, I still need services, I want to go on to Medicaid, and I have a dollar for dollar plan. My insurance company has paid out $200,000. I want that to cover my home. So I can go on to Medicaid, but again, they're not looking at my home. It's like that doesn't even exist. They still will they'll look at any of your assets beyond that protection. So if I have some savings or something like that, they will look at that, and those will be looked at according to the Medicaid spend down rules at that time. But you can choose what you want to protect.
So in a way, this would make more sense for people who didn't have as many assets.
Exactly.
Yeah.
Total assets, if a total asset policy is more expensive than a dollar for dollar policy, and obviously if you have a lot of assets, then you want to look into a total asset policy. Someone who we always say, if you have a home you'd like to keep in the family or pass down, that might be a really good situation where you're looking into your dollar for dollar.
We talked to a woman last spring who was interested in a dollar for dollar plan, and she wanted to protect her home because she had no children, had no relatives, no heirs. She wanted to give it to her church. And so if she could buy a policy that would protect the value of her home, then that was what she was interested in. And then that way she could then donate that asset to her church when she was finished with it. And so people buy long-term care insurance for a whole variety of reasons. We want to also, I think, point out that what you're protecting with long-term care insurance is assets, not income. So you will still have to be subject to Medicaid rules when you go on to Medicaid, should you go on to Medicaid at the end of that time.
In other words, if you are still alive. Really.
If you're still alive at the end of 3 or 4 years, whatever your policy is, to pay for your care. But your assets will not be touched. So really, when people are planning for their long-term care needs, and we know that lots of people will do things besides long-term care insurance, we're really interested in educating the public so that you have the tools to be a more informed consumer. But you need to think about both protecting your assets and your income. So some people will say, well, I've just gone to my insurance agent and I have a plan, now I'm set. Well, no. You need to talk to a financial planner or a tax person who can help you with the income side of your planning. So you don't want to just put all your eggs in one basket, so to speak, and say, well, a partnership policy is going to solve all my problems. No, it isn't. You need a more comprehensive plan.
The income part is interesting because I don't really understand how that would work. What is income? I guess it's interest and all that.
Yeah, it's pensions, it's Social Security. You can't do much about those.
So if you get capital gains on your 401k, that would be income?
Yes. But because under a partnership plan, the Medicaid assumes that you have no assets. Let's say while you're paying for your care, while the insurance company is paying for a major portion of your care, you can be drawing money out of your 401k at, let's say, a maximum distribution. When you go into the nursing home, and you're on Medicaid, going to Medicaid, you could change that 401k or IRA distribution to a minimum distribution.
Okay.
So you could actually hold back some of those assets. So there are things you can do. Since it is assumed that you have no assets, you can therefore make change in them. And so you can take an income producing asset and change it to a non-income producing asset, and therefore minimize your income.
So you really do need some advice here.
You need advice. You need to talk to people who actually understand your particular situation, because everyone's situation is different.
Now you mentioned what we would probably all agree is fairly high costs for the nursing home care per day. You said something about 200?
Per day, the average for New York State is $263 at this point, and that varies from county to county. So you really want to look. One thing that's very important when you're looking at purchasing an insurance policy, you want to know how much does care cost in your area. If I move down to Long Island, that costs close to around $350 a day, whereas here in Albany it probably costs closer to $240.
But we might be able to tie that into the income. I think I read in one of your booklets that you could take some of the income and use that to pay the difference between your policy and the cost per day.
That's what you need to do.
Right.
Yes.
So this is a very interesting piece of the puzzle in terms of how do I know I bought enough? Well, if you have income that you can arrange through savings,
Right.
and you have this policy,
I'll just give a quick example. My parents were looking into long-term care insurance and discussing you don't want to buy too much. You don't want to buy too much insurance, but you also want to make sure that you buy enough insurance. So in a situation like that, like theirs, they, even though that they know in this area you're looking at $240 a day, they weren't going to get a day, they weren't going to ask the company to actually pay $140 a day. They were looking at more at $190 or $200, assuming that they will cover the difference with their own money, with their own income, and then that way keeping the cost of the policy down.
Yeah, there's inflation protection built into all the partnership policies. So if I buy a policy this year for $198 a day benefit, it will go up over the next 10, 15, 20 years, 25 I hope at least, many years I would need, compounded. It's 5% a year compounded, which means the benefit level will double every 14 years. So and you can buy, by the way, non-partnership policies that also have that inflation protection built in. And I think that's one of the things that people really need to look at. We know that. And by the way, 5% compounded a year is the average. Mm-hmm. It's a historical average for long-term care costs to be going up. Mm-hmm. So if you buy...
I think that what works out, every 14 years it'll double. So if you purchased a policy that was going to pay $200 a day for your services, in 14 years, if you haven't used it, that's automatically going to be $400 a day. So inflation protection is extremely important.
the light bulb just went on. So in other words, if I buy coverage today and I say, okay, $198 per month is fine for me, my premiums might not go up, but my coverage is also not going to go up unless I have that inflation protection.
If you have a partnership plan, all partnership plans have inflation protection, and your premiums are based on your age at the time you buy the policy. So unless the Department of Insurance increases the premiums for every company that is offering plans in that particular class, and by the way, I think it's how many times? Two times they've raised the...
I'm not sure.
There are very, very few increases in the premiums. Your premiums are going to stay flat.
I suppose that's not as difficult for the companies as it would be if the costs were so variable. If they know they're going to be paying out this much, that's not going to go up either, so they shouldn't have to raise their rates so much.
Right.
Correct?
Mm-hmm. Yeah, and New York State's very good about making sure that the rates are going to generate enough reserves. We've talked to people who say, well, I can go to Florida and I can get a 25% discount if a couple buys a policy. New York State is reluctant to do that because long-term care insurance is actually a rather new insurance product. So not a lot of people have used the benefits. New York State wants to ensure that there will be adequate reserves, that every company will have adequate reserves to pay the premiums. So they make sure that the premiums are set at a level now that they think will sustain those policies for the life of the policy, and not simply give you a good deal now and then have the insurance company run into trouble 25 years from now when it has a whole bunch of people trying to
When you need
access
it.
benefits. Right.
Plus, you have, if you increased the premiums greatly, people wouldn't be able to afford to continue to pay their premiums, so you would have people dropping out all over the place. So they really take that into consideration. They're very consumer-driven.
And that would be really against the whole spirit of the
Absolutely.
process.
Right. Right.
Now, you mentioned moving to Florida. I think that's probably not in the best interest of somebody who has purchased a partnership plan. Is that correct?
Exactly. There are, if you buy a New York State partnership plan, you have to be a resident of New York State when you want to apply for the Medicaid extended coverage. Now, I can buy a policy, for the example that we've been using, I buy a 3-year policy, and then I decide I'm going to retire down in Florida. I can go and move down to Florida, and if I need long-term care services, I can start accessing benefits down in Florida for that 3 years. But once that 3 years is done and I want to get onto the New York State Medicaid extended coverage, Florida really doesn't care that you have New York State Medicaid coverage. So you do have to come back to New York State to be able to apply for the Medicaid extended coverage piece, which is very important. If you have family that lives out of state and you think that you have a really good probability of moving out of state when you need long-term care services, then you might not be looking at a partnership plan. You might be looking at a regular, just traditional plan. But that's something that you really need to keep in mind when looking at the insurance policy.
Now, that sounds like, okay, you moved to Florida, you enjoy 10 years, and now you need nursing home care. How long does it take you to establish a permanent residence in New York and move back?
You can do it, I believe, the same day.
Oh.
It's just you need to show that you are going to be a resident of New York State, and so that you can come back and the day before move back to New York State and then apply for the Medicaid extended coverage.
That brings up another thing that I didn't know anything about before I started reading up for this show, and that was there's a period of time, I forgot what it's called, before which coverage kicks in.
Elimination period.
Right. Could we talk about that a little
Sure.
bit?
It's like a deductible. You know, you have every insurance policy has a deductible. You have your car insurance, and if I'm unfortunate enough to have an automobile accident on my way out of the parking lot today, my insurance company I will have to pay the first $500 of my cost of the accident. It's the same way here. An elimination period can be 20 days or 40 days or up to 100 days. It can even be longer. We actually ran into a man who was rather shocked.
180 day. Basically, it's just the amount of time that you're going to pay out of pocket for your services. And you can purchase a policy that has no elimination period. So the day that you need services, the insurance company will start paying benefits. The thing that you have to consider is something like that, deciding whether you want no elimination period versus a 60-day elimination period, affects the cost of your policy. If you want the insurance company to kick in automatically and start paying right from the first day, that policy is going to be more expensive than if you decide, I'll take a policy that has a 60-day elimination period where I'll pay the first 60 days of my services and then the policy will start providing benefits for my care.
Medicare generally will pay about the first 20 days of nursing home care, and then after that it goes down substantially. AARP did a survey a few years ago, and they found that about 54% of Americans believe that Medicare will pay for their long-term care needs, which is completely false. Medicare is essentially an acute care health insurance policy. It's designed to pay for hospital stays, for doctor's visits. It doesn't really pay for long-term care. The long-term care benefit is a rehabilitation benefit. So to use sort of an example, if I go out and I walk out of the library and I slip on a banana peel and I break my hip, I would go to the hospital, and Medicare would probably pay about the first 5 days of my care in a hospital, and then they would send me to a rehab facility, and that would probably be a nursing home, and I could spend a couple of weeks in that nursing home, and Medicare would pay that nursing home rate, and that's part of their long-term care benefit. And then I would go home, and I would get up to about 50 visits from a nurse, and I would get some physical therapy and that sort of thing. That's what Medicare does. So some people will take an elimination period of 20 or 30 or 40 days, assuming that they will have some. Medicare will pay some of that benefit. But taking a long elimination period means that you're going to have to pay a substantial amount. But as Monica said, the longer the elimination period, the lower the cost of your premium. Long-term care insurance is like any other insurance. The more bells and whistles you add to it, the more expensive it's going to be.
And from what I'm getting, there isn't a magic formula where you can say, do this or don't do that. You need to get your calculator out. You need to look at scenarios based on your own situation and see, is this worth it or is that worth it?
Yes.
And really take into consideration, what are your goals? Where do you want to be? Do you have family members? Do you have a large family? Are there kids that are going to be able to help provide some care? So a lot of different things individuals need to really keep in mind when coming up with their equation.
We're getting close to not having time, and is there something that I should have said, something that I've left out? Or have we covered it pretty well?
I think we've covered it pretty well in terms of what we really do is we really provide a set of services to make people more informed consumers. Monica has a very nice phrase that she uses.
And that would be
that you want people. You don't want
our purpose is for someone not to come up, an agent especially, to come up and sell you insurance, but for you to purchase the insurance that you need. So in essence, to be an informed consumer. I think the probably biggest thing that we would really like to talk before we leave is that we really want individuals to know that every county within the state now has a long-term care insurance resource center. So anyone can call their office for aging within their state, or within their county, and find out who they can talk to get in touch with the Long-Term Care Insurance Resource Center. And then you have individuals like Bill and I. We provide a number of different, and they're free services. We go around the county providing presentations. We will be doing a presentation at numerous libraries and so on. They're open to the public. We provide one-on-one counseling and phone counseling. We also, individuals that have already purchased a policy can come and bring their policy to us, and we can go over it page by page with them to make sure
now,
that they
how about if
understand.
could they get quotes, get something set up before they sign it and let you go over it?
That's a really good question. The one thing that people need to understand, when they purchase a policy, they do have a 30-day free look-back period. So they can purchase a policy, and once they get it, they have the 30 days to decide, what was I thinking? Maybe I don't want this, or maybe I just want something different as part of my policy.
Could they adjust it as well?
Yes. So they can come. I have a lot of individuals that come to me within that first week or two of getting the policy. We go over it to make sure that they understand exactly what it's going to cover, what it's not going to cover. And then they can decide, yes, that's exactly what I thought I was getting, or no, I never really thought of that. So I have individuals that meet with me before they meet with an agent and really go over some of the details of what they're going to want as part of their policy, and after the fact. So it's really...
And sometimes they'll come with two policies. They'll have two quotes, and they'll want us to go over, and we go through and we make sure that they understand the terminology. We want people to understand so they can ask informed questions, and that gives them a little better feel. If they can ask informed questions, and the insurance agent seems to give them all the answers that add up to what they've heard and what they've read, then they can have a little more confidence than if that person doesn't seem to know the answers, or gives them answers that don't make any sense based on the material that they've studied and what they've heard from us.
Great. We'll put up at the end the phone number. You want to tell us what that is?
It depends on what county you're in. Again,
right here.
Albany County.
For Albany County, I did bring the number. It's 447-7177.
So-
And that's their hotline that you can call in. You'll talk to somebody, and they'll immediately refer you right over to us.
And we'll put up the website right now, and people can read that off the screen.
Okay,
Great.
thank
I want
you.
to thank you both, Bill, Monica.
Well, thank you.
And I want to thank everybody for watching. Hope you enjoyed the show, that you'll follow up with these people if you have questions, and wish you a great week. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.